Tesla beat earnings, EPS 41 cents versus 37 expected, gross margin 21% versus 17.5 estimated, free cash flow flipped from negative 1.6 billion expected to positive 1.4 billion. The stock popped 4% in after hours. Then Elon started talking. 90 minutes later, every penny of that gain was gone. The stock closed down. 6 hours before the call, we told you this would happen. Our CVD signal said down. It's now 8 for 9, 89% accuracy across 2 years of earnings. Here's what the numbers won't tell you. Let me walk you through exactly what happened last night. 4:05 p.m. Results drop. The numbers are genuinely strong. Stock jumps to 401 plus 4%. For 90 minutes, the market is pricing in a legitimate beat. 5:33 p.m., the call starts. Elon's first words, substantially increasing investments, significant increase in capital expenditures. The stock starts falling immediately. CFO Taneja confirms, CapEx will be over 25 billion this year, up from 20 billion last quarter. Negative free cash flow for the rest of the year. Stock drops $7 during the opening remarks alone. By 6:30 when the call ends, all 4% is gone. The stock that beat earnings by 11% closed down. And here's the thing we said in part 1 of our earnings preview. The CapEx increase was telegraphed. Last quarter, the CFO explicitly said the 20 billion did not include Terafab or the solar fab. This wasn't new information. The market just needed a reason to sell, and Elon handed it to them. 21.1% gross margin, that's the headline. 478 basis points higher than a year ago. Analysts expected 17.5. It crushed. But read the fine print. Tesla's own shareholder deck says, and I'm quoting directly, increase in automotive one-time benefits related to warranty and tariffs, and increase in energy one-time benefits related to tariffs, one-time benefits. Warranty adjustments and tariff refunds are not repeatable. Strip those out and the margin improvement is still real. Lower material costs, higher ASP from Juniper mix, growing FSD revenue, but it's not 21% real. Auto gross margin excluding regulatory credits hit 19.2%. That's genuinely impressive. Best since 2023. But sustainable? That depends on whether the tariff and warranty tailwinds continue. Tesla reported non-GAAP earnings of 41 cents per share. That's the number you saw in every headline. But GAAP earnings, the actual number under accounting rules, was 13 cents. 13 cents. That's a 28-cent gap, the widest it's ever been. Where did 28 cents go? Stock-based compensation. Tesla paid $1.03 billion in stock comp this quarter, up 80% year over year. That's 23 cents per share that Tesla excludes when they tell you they earned 41 cents. And the biggest chunk of that $1 billion is Elon's 2025 CEO Performance Award. His new compensation package started getting expensed in Q4 last year, and now it's over $1 billion per quarter. So when Tesla says we beat estimates, they're excluding $1 billion a quarter in compensation, $3.3 billion trailing 12 months. That's real dilution hitting every shareholder. Tesla's energy business just printed 39.5% gross margins, nearly double the auto segment, $952 million in gross profit on $2.4 billion in revenue. But here's the paradox. Energy storage deployment dropped 38% sequentially, from 14.2 gigawatt hours in Q4 to 8.8 in Q1. Revenue down 12% year over year. The highest margin business is the one that's shrinking. Tesla says it's a timing issue. Megapack deployments are lumpy quarter to quarter, and that's probably true. But the margin jump from 29% to 39% also includes one-time tariff benefits. The bull case for Tesla isn't cars. It isn't even robotaxi yet. It's energy at scale. If they can sustain 35+% margins with Megapack 3 and the Houston Megafactory coming online, that changes the entire valuation story. But we need to see the volume come back first. 1.28 million active FSD users, up 51% year over year. Record net new subscriptions in Q1. Sounds great, but that number includes everyone who ever paid full price for FSD, $8,000, $10,000, $12,000, plus monthly subscribers at $99 a month. Tesla won't break out how many are actually paying monthly, and the Q1 spike was inflated. Tesla killed the one-time purchase option this quarter, so there was a last-chance rush of people buying before it disappeared. Classic deadline-driven demand. Here's why next quarter matters. Since one-time purchases are dead, every net add from Q2 forward is a real monthly subscriber. If growth stays at 150,000+ per quarter with no FOMO buying, FSD at $99 a month is a real product. If it drops to 50,000, Q1 was just a sugar rush. Let's talk about what's actually happening on the ground. According to the independent robotaxi tracker, Tesla's total tracked fleet across all cities is 644 vehicles, 512 in the Bay Area, all with safety drivers, 45 rider vehicles in Austin, 2 in Dallas, 2 in Houston, unsupervised vehicles, 17 total, across the entire country. Cumulative paid miles hit 1.7 million in Q1, up from 610,000, nearly tripled. Growth rate is impressive, but context, Waymo does about 750,000 miles per week. Tesla has done 1.7 million total, ever. Elon was asked on the call why not deploy more vehicles. His answer was revealing. The real bottleneck is the software getting stuck. Cars getting paranoid and refusing to move, can't cross railroads, stuck at red lights that never change. And Lars confirmed on X there's no regulatory cap on production. The bottleneck isn't the law, it's the code. His exact words, the single biggest thing is the car being scared to move. Infinite loops, that's why 17 vehicles, not 1,700. Here's something that didn't get enough attention. An analyst asked whether AI5 has been dropped from the vehicle roadmap. Elon's answer, a modified AI4 is on the way instead. Not AI4, modified AI4. That one word does a lot of heavy lifting. Because Elon needs you to buy an AI4 car today. Every Tesla shipping right now has AI4 hardware. If he admits AI5 is required for true unsupervised autonomy, demand collapses for the current lineup, and we already know Hardware 3 is dead for unsupervised. Elon confirmed it on the call. Hardware 3 will not be able to be considered safe. They're offering a discounted trade-in for AI4 hardware. Modified AI4 gives him the escape hatch. If it works, great. Current cars are fine. If it doesn't, he can say it needs a hardware update, cameras, compute board, and that's the modification. Either way, he doesn't kill today's sales. Capex confirmed at over 25 billion, up from 20 billion last quarter, up from 8.6 billion in 2025. The CFO said this will result in negative free cash flow for the rest of the year. But the real story is where the money's going. Tesla invested $2 billion in SpaceX equity this quarter. It's right there in the cash flow statement. And Elon said on the call that SpaceX is going to take care of the initial phase of the scaled-up Terafab. His exact words, it's going to have a lot of complexity because Tesla and SpaceX shareholders and boards have to be served. He's publicly acknowledging the conflict of interest. Tesla shareholders are funding a chip fab that SpaceX will build and benefit from. The related party complexity is growing every quarter. This is the thread the 10Q filing will pull on. And then the 10Q dropped, filed today, and buried in Note 14, subsequent events, is something Elon didn't mention on the call. In April 2026, Tesla entered into an agreement to acquire an unnamed AI hardware company for up to $2 billion in Tesla stock. 90% of that, $1.8 billion, is tied to service conditions and performance milestones. The leading candidate, Anant Navarti, Tesla's own former chip architect. He left in December to start a stealth AI silicon company. He came back in early April as head of silicon engineering, leading AI6 and Dojo 3. He was gone for 3 months. The startup barely existed. This looks like a $2 billion acqui-hire, a retention package disguised as an acquisition, on top of the $1 billion a quarter in SBC already being expensed. But the 10Q revealed more. The warranty reserve story, Tesla released $175 million in pre-existing warranty reserves back into income. Last year, the same line was a $347 million addition. That's a $522 million swing year over year. That's a big chunk of the margin improvement everyone is celebrating. The tariff refund hasn't even been booked yet. The Supreme Court invalidated certain IEEPA tariffs in February, and Tesla says they may be eligible for refunds but haven't recognized them. That's a hidden upside for Q2 or Q3. And Elon's comp package pushed the effective tax rate from 29% to 34%, $40 million a quarter in extra taxes because his stock awards aren't tax deductible, $160 million a year that goes to the IRS instead of shareholders. The energy backlog is $10.15 billion, $5 billion expected in the next 12 months. Demand isn't the issue, deployment timing is. And the FSD deferred revenue grew to $4 billion, up $130 million in Q1. Tesla's golden era. Cybercab generating revenue, Optimus in production, FSD unsupervised for customers, energy printing cash. It's all being built. You can see the Cybercabs in the outbound lot. The Fremont line is converting to Optimus right now. AI5 is taped out. Dallas and Houston just launched. The pieces are physically real, but nothing produces material revenue in 2026. Elon said it himself. Unsupervised FSD will not be material this year. Cybercab just started pilot production with battery packs as the bottleneck. Optimus production is late July-August at the earliest. Energy margins are incredible, but deployment is shrinking. The golden era got pushed from H2 2026 to late 2026 at the very earliest, probably H1 2027 for anything that moves the income statement. And the stock at 385 is priced like it's 6 months out, not 12 to 18. That's the tension. Every piece is real. Every timeline is late. Here's the rule with Elon. When he gives specific dates, Austin by June, Optimus by July, add 3 to 6 months. When he says something won't happen, unsupervised FSD not material this year. Believe him. The sandbagging happens on products that are physically being built. The overpromising happens on timelines, what he's likely sandbagging. Optimus. The Fremont SX line is already winding down. You don't shut down a revenue-generating production line unless the replacement is closer than you're saying. FSD China. He said hoping for Q3, but the Netherlands just approved supervised in April. If China approval comes in Q2, that's a massive catalyst nobody is modeling. What he's likely overpromising. A dozen states by year end, he has 17 unsupervised vehicles across 3 Texas cities. Going from 3 cities to a dozen states in 8 months is classic Elon timeline, and the one that could go either way. Unsupervised FSD not material this year. If V14.3 fixes the scared to move problem, Q4 could surprise. If not, he was just being honest. Let me bring it back to where we started. 3 days before earnings, cumulative volume delta turned negative, minus 4.3 million. The strongest bearish reading in 2 years of data. Institutions weren't waiting for the EPS number. They made the decision to sell on Thursday, Friday, and Monday, before any of this was public. They used the 4% pop on the beat as exit liquidity. The only thing that could have changed the outcome was a genuine surprise in Elon's remarks, a rabbit out of the hat. None of that happened, so the stock went exactly where the big money planned it 3 nights ago. 8 for 9, 89%. The numbers don't move Tesla, the call does. And the big money already knew. We dug through the earnings deck, the full call transcript, and the 10Q filing that dropped today. Every number, every footnote, every quote. The big money made their decision 3 nights before earnings. Our CVD signal caught it, 8 for 9. And the 10Q revealed what Elon didn't mention on the call, a $2 billion acquisition buried in a footnote. If you found this analysis valuable, subscribe and follow. We do this for every Tesla earnings. Full data, no hype, just receipts. Follow at @NTonicStock, pick on X, Trade Alerts AI on YouTube, and Trade Alerts AI 777 on TikTok. Full earnings analysis and CVD data at TradeAlertsA777.com. Not financial advice. See you next time.